This is about not being shaken out. This is understanding how simple this game actually is.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault, the show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times here. With exclusive access to experts and insiders, we reveal information and insights that you simply won't find anywhere else. Hi, my name is Shane Moran, and I'll be your host for this week's episode, and we'll be joined shortly by the one and only precious metals expert and whistleblower, Andrew Maguire, as we pull back the curtains on the intricate world of the gold and silver markets as we expose what's really going on in the precious metals industry. So get ready for another blockbuster episode of Live from the Vault as we bring you knowledge and understanding that you just can't get from the mainstream media. Why is that? Because they won't provide you with this type of information. And with that, let's head over to the UK and talking gold with Andrew Maguire. Now, Andrew, as we move ever closer to a globally set gold price reevaluation event, you've been talking about this for a little while here. We usually start off these important market updates and these episodes by really connecting the dots between episodes so as to provide us with an insight into where we are in this long-standing paper and physical battle. Where are we, Andy? What's happening?
Yeah, Shane, great to be with you again. And of course, with great to be here for everybody. Look, this is, as Shane, you know this, and our subscribers know this. One of our main objectives is really just to dig below this smoke and mirrors world of the COMEX. This illusion that they essentially, and really what we're trying to do is just expose exactly where we are in this really what is an ever thinning paper market that is moving into a much more liquid physical market. And what we're doing is look, what we want to do is track where the insiders' footprints are so that we can make better gold and silver accumulation choices. Okay, if you're a stacker, no problem. But it's good to know where we are in this battle. So in other words, what we're saying is not to be shaken out by the deliberately generated, counterintuitive price volatility, but rather to welcome these synthetic-driven price strips so that we can take more of this ever-dwindling supply of physical gold and silver, of course, that underpins each ounce of gold the Fed leverages. And yes, Shane, we are talking silver too. So now, look, while leverage has historically worked in the favor of the manipulators, of the cartel, of the Fed. And as we know, leverage can work in both ways. And while there is still a group of US traders confined to the deliberately rigged casino that are still blissfully unaware that in the real world, outside the oxygen-fueled casino, just 5 short months ago, we talked about this. As it happened, gold became a first-tier asset class that competes with treasuries and all manner of other first-tier assets. Now, however, as we've highlighted, there are exceptions here, as the House relied upon speculator group has actually split into 2 groups. Now, one led by the noose, borrowing gold and silver from the House and easily rinsable. But we're also evidencing an increasing number of CTAs, commodity trading advisors, who are legitimately using gold futures to hedge risk positions and are sticky. So it's important to keep that in mind. Now, we've looked in detail at this extremely important split in this speculator group in recent episodes. So I won't waste time here as there's so much new to cover here. And with this in mind, in this episode, we're going to focus on the 2 primary tools that the Fed utilizes to try and manage their extremely wrong-footed paper market bets into an ever-dwindling group of rinsable speculators. Now, the preferred tool is the directionally programmed high-frequency trading bot that gears speculators to tick-for-tick buy or sell gold and silver against the dollar index. Now, we've talked about this multiple times, and why speculators, when taking this bet, are entering into a dangerous naked short bet that could easily result in unlimited losses. Now, the secondary tool, which is the trade at settlement tool, the TAS, is used in conjunction with the primary tool, but with the specific mandate of igniting synthetically driven monthly downside price air pockets, which we see all the time, which is what all that is the pit managers are using this to capitalize on price moves. Now, however, in both cases, these paper games are at the cusp of blowing up. And we will explain how this game has been sussed out by a competing central bank, sovereigns, and some very smart institutional money managers. And short-term volatility aside, under the smoke and mirrors, the Fed is the only remaining central bank that is trying to delay an inevitable gold price revaluation and are losing this battle. Now, before we drill down into this, let's first pick up the thread from last week on the little reported move by Beijing to incentivize millions of fresh gold buyers, as this is creating a supply deficit not factored into the current synthetically diluted price of gold. The word is Beijing Gold, this Beijing Gold Initiative is picking up steam and is driving unanticipated, unfactored physical gold demand, which at the margin will drive offers to sell physical gold in the global marketplace at a much higher price.
Now, Andrew, we've had a ton of questions about this. I know you're the insider of insiders. What are you hearing out there about this exact topic here?
Yep. It's 3 weeks ago, just over 3 weeks ago, we drew attention to the PBOC moving to widen gold and silver accessibility to millions of previously untapped section of the Chinese citizens. Now, this fresh new gold accumulation initiative, it follows a very similar push undertaken 13 years ago that had incentivized the wealthier middle class section of the population to invest in physical gold. Now, what is interesting is that while gold has been woven into the fabric of Chinese culture for thousands of years, with gold buying viewed as a sign of good luck, fortune, auspiciously accumulated at festivals, marriages, and widely gifted, so far, the masses have had very little exposure to gold and silver as an investment asset class. And this is the difference. China's fresh initiative to encourage this less wealthy section of citizens to diversify into precious metals makes it easy for millions of existing RMB bank account holders to really convert these cash savings into a deliverable, that's the key, deliverable physical and silver, physical gold and silver, and they can do this with a click of the mouse. Suddenly it just opened up. There it was, looking at your bank account, the option, buy gold, buy silver, and incentivizing them to do it. So why are we seeing this governmental push into gold being incentivized now? What's going on? Why now? And the following feedback, really, that we're going to talk about now, comes directly from a very reliable, well-connected source. Now, as we noted in our Live from the Vault episode on the 4th of May, and that was we talked about following Xi's re-election, he directly responded to Mark Miley pitching Congress for an increase in the Pentagon's 2024 budget to prepare for a future war with China. Now, he was clearly referring to Taiwan and increasingly dangerous confrontations in the South China Seas. But Xi issued a mandate to, and this quote, prepare his country and citizens for war. Now, this thread continued this week with US Secretary of State Blinken, Jamie Dimon being wheeled out, raising the subject of de-risking US relations with China. Now, not just decoupling, but de-risking. Now, when Xi said he's preparing his countries and citizens for war, at face value, it is not as the increasingly woke military might interpret it. It's more like the art of war, as in the midst of chaos, there's also opportunity. So let's connect the dots further. Right, having opened up the Central Asian corridor, which is providing sanction-proofed overland connectivity between Iran, Turkey, China, it encourages gold investments. Encouraging gold investments for its citizens is the next step in sanction-proofing itself and its people in anticipation of the dollar being weaponized against China. So let's look at the scale. For the renminbi to be liquid enough to absorb an ever larger percentage of the global commodity and energy settlement flows, the underlying yuan underpinning the offshore renminbi, along with the BRICS Plus alliances, is going to be increasingly backed by physical gold. Now, while this is not an overnight process, and we're not saying it is, nor is Beijing ditching all its US assets at once, but they're undoubtedly in the process of stealthily opting out of the hegemonic dollar-based system, which requires, obviously, opting in to a sufficiently liquid alternative medium of exchange for its trade with its partners. Now, physical gold, once delivered, is the only global currency that has zero counterparty risk and is infinitely fungible, has been for 5,000, 6,000 years, and is sufficiently so to provide a liquid solution to be able to ultimately opt out of the dollar and into a gold and interconnected hard commodity-backed solution, which is what is underway. And hence, this is China's immediate focus is actually on stealthily breaking up US dollar dominance in parts of the world, starting with where Beijing's trading partners are. It makes sense. And this is well underway. So in the event of any one of China's red lines being crossed, their Sino-Russian alliance would be able to access a potential unaggregated 60,000 tons of physical gold reserves to provide this unfactored, unpriced opt-in solution. Now, conservatively, we're talking 20,000 tons of unpublished PBOC reserves. Many people see it higher than that. We're using minimums here. There's 25,000 tons auditably held by citizens, along with its gold alliance agreements. It has a wartime trade partner with Russia, easily aggregates really what is accessible to this group, a staggering 60,000 tons. Now, this move by Beijing to open up gold to its citizens also provides them the ability to commandeer these privately held physical reserves in order to bolster as yet hidden PBOC reserves that are salted in the state-held banks. Now, such a warlike measure would not be considered to be a Western-style bail-in, really revealing the real level of gold reserves. Once you reveal the real level of gold reserves, held by the China, it would almost certainly see these gold reserves quickly rise in value against the fiat dollar benchmark. And while also bolstering the gold bank accounts of its citizens, they're going to be more than willing to be seen to be patriotically watching their gold investments significantly appreciate in value. Now, once China reveals the extent of its gold reserves, it will force every Western central bank to revalue gold. And the global gold price would easily top $2,500 in very short order. And we talked about much higher prices than that, probably $6,000, and the rationale for that in the last episode. So please go back and look at that. But so this is why we're seeing the statement by the PBOC. These freshly incentivized gold investments will provide a return to investors based solely on price appreciation. But as we will shortly look at, the PBOC will and are already once again protecting these freshly incentivized SGE gold investments from price from a Western generated paper market price collapse. Now, as physical gold, yes, Shane, you can also read silver into this. As they get readopted as fungible global settlement currencies amongst the SCO trade partners, gold will shake off its paper wrappers. And all monetary metals, every single one of the four monetary metals will be revalued to a much higher supply-demand price than is presently baked in to the paper-diluted, unbacked dollar gold benchmark. Now, what is notable is these freshly incentivized gold investments are designed to provide a return based, as I say, solely on gold price appreciation. And the last time the PBOC encouraged middle-class citizens to buy gold back in 2010, they also moved to underpin that gold price. And our liquidity providers exposed to the Chinese market suggest the gold price is anticipated to once again be underpinned by the PBOC, but this time really around $900 higher than the equivalent dollar price that we saw in 2010. And as was just exposed into the end of the month, we look at the short-term action, you can see the intraday action, you can see the monthly action. Into the end of the month, COMEX rigged sell-off. Everyone looks at the price coming down. What's going on? Just as we saw in 2010, we once again see the PBOC at work actively underpinning the SGE gold price. Now, this exposes really the nature of these two siloed global gold markets. One is paper and one is physical. And as we know, mainland China, Chinese physical gold, is forbidden from being exported, yet it is continually being imported in all forms. Now, on grid, as reported by the SGE, which is hence the data evidencing the what's held privately by and sourced through the SGE auditably, what does not flow through the SGE is unreported by the PBOC. And why would they report this? It's private. This is a central bank doing what it needs to do to manage its positions. Now, the central bank gold that is salted around the state-held banks can, when it best suits Beijing, be monetized by way of a click of a mouse to back the RMB, overnight making it the strongest currency cross of all other unbacked fiat currencies. People doubt this, but once you back something with physical, it's no longer a purely fiat currency. So really, following this fresh PBOC gold purchasing mandate being opened up, we've evidenced the SGE premiums over London spot acting as a price management flywheel. We've witnessed this since this a new incentivized gold buying program. And then we've seen it expanding and reducing premiums over the local London spot price as necessary to insulate freshly incentivized Chinese gold buyers from excess CME LBMA derived paper market volatility. Now, concurrently into the Fed-centric generated price dips, the PBOC is soaking up and alchemizing COMEX-centric paper market liquidity, including tapping the GLD ETF, this illusionary ETF that is spun between the LBMA professional trade. Oh, guess what? Then, as we saw in 2008, we're seeing that GLD ETF being drained. This is tightening the noose on paper gold. Now, this looks very much like a playbook from Sun Tzu's The Arts of War. In the midst of chaos, there is also opportunity. So to provide context, during the end of month COMEX Games sell-off, the SGE premiums have, when necessary, intraday expanded as high as $98 per ounce over the synthetically driven COMEX price action. Conversely, when the London gold price rises, by design, these premiums contract accordingly, with SGE gold pretty much ironing out a lot of this Western-generated paper market volatility and maintaining a much more stable price, kind of varying somewhere between $30 to $100 an ounce as may be necessary. So this move by China to underpin the SGE gold price shines a light on the clash of these two global siloed gold markets. One, the SGE 100% backed with physical bullion, and the other, the COMEX unbacked by physical gold. This is an inflection point that should have our attention. And as we previously have drawn attention to, the Fed is the only remaining central bank that is net short gold. And the problem for the Fed is that their sole remaining COMEX-centric price management tool, which we're talking about, are being picked off by global exchanges accessing the casino's EFP backdoor. And we know what the EFP is. It is simply a mechanism for the COMEX to transit an unbacked, non-NSFR compliant paper gold futures position into a spot compliant deliverable position.
Wow, that is absolutely fascinating. Now, this is exactly what you were talking about and you were referring to earlier in terms of the Fed tools are going to backfire. Can you share with us maybe a little bit more in detail on this backfiring of these tools?
Absolutely, Shane. And this is where we shine that light on the swan song of the two major Fed price suppression tools. There are others, but they really rely on these two to even function. With the price-setting COMEX derivative markets siloing US traders inside a rigged synthetic casino trading environment, it's often forgotten that gold and silver are in fact foreign exchange currencies. Now, in the real world, both gold and joined at the hip silver really trade as components of an interconnected multi-trillion-dollar global foreign exchange market. People forget that because they're siloed inside the casino. And while the Fed, in agreement with other central banks, admit that they regularly intervene in the foreign exchange currency crosses by agreement, such as the dollar, yen, the euro, the pound, of course, none of these fiat currencies have any hard backing to them. And the very act of intervening in them at a keystroke increasing fiat money supply illustrates this can be done. But what we've previously looked at, the primary Fed tool to manage gold against the dollar, is also conducted in the foreign exchange markets. However, after cracks appeared in the LBMA gold market in 2013, huge cracks appeared. People were unable to, were demanding delivery, couldn't get it. US traders were suddenly forbidden by the CFTC to directly trade gold as a currency cross. This was to lock these US traders inside the proxy paper-driven COMEX casino, where they could intervene. It's a bit like in the old wire fraud days when you'd have the horse racing and someone would already know they delay the feed, you know. So it's almost akin to that. And we've previously looked in detail at the mechanics of this foreign exchange trade, which in plain vanilla form simply means if you're long one leg of a foreign exchange cross, you're short the other. It's that simple. That's how foreign exchange works. So when you're long dollar, it means you're short gold. So with these constraints in place, it locks the US traders into a proxy futures trade that the house controls. However, outside the casino, this year, on the 1st of January, FX gold was raised to a cash equivalent first-tier asset class, forcing liquidity providers to back these foreign exchange trades with physical gold, exposing a major flaw in the casino's 50-year rigged unbacked paper gold game. And unlike the NSFR compliant foreign exchange market, these same market-making COMEX liquidity providers straddling a foot between both markets, privileged to do so, they're not required to back the COMEX leg of these trades with physical. This means the COMEX proxy FX gold dollar trade represents a naked short bet against gold. Exactly what Basel III NSFR conditions was seeking to avoid. Now, naked short in so much as, while both are technically a first-tier cash equivalent, I mean, long dollar should be a first-tier cash equivalent, physical gold has zero counterparty risk, whereas some 32 trillion of national debt and growing, I mean, backing the dollar leg, that does pose infinite risk. So they're not equal. I mean, as an aside, that's what, $95,000 of debt for every single person in the US. But look, I'm digressing. The divergence is why the COMEX proxy trade is going to backfire. This time, even more dramatically than was evidenced in September 2008, when gold surged for 3 solid years without any pullbacks. It rose by over $1,200 an ounce, often in times in sync with the dollar, because they were printing dollars following QE being implemented, and we saw gold rising along with dollar as a safe haven. And call it a safe haven if you wish. So we're going to see this breaking of this tool. And with this in mind, let's kind of drill down into the month of May, which we've just been through, and how this siloed, counterintuitive COMEX-driven action, as it progressed, it provided a perfect example of why, due to paper market liquidity outflows, the Fed will ultimately have to abandon this tool and move to revalue Treasury gold before a rash of repatriation requests exposes the degree of the rehypothecation of these unaudited 8,133 tons of reserves. We talked about that in more detail last time. But last week's COMEX-centric options gaming, and we talked, don't glaze over, guys. Options just simply a derivative that comes to expire at the end of each month, and everything is rigged. These tools are used to make the price close mark to market at a particular day at the end of a month, usually. And what it does is it's gamed by the short-term pit managers, enriching them enormously, while really severely wrong-footing this dwindling group of speculators, which are split now, who are still dancing to the tune of this automated inverse gold and silver dollar index algorithm. Now, this highly leveraged, momentum-driven synthetic action, it really has fed off a week-long. We saw a huge rising dollar index, driving paper and gold and silver into grossly oversold levels. So really, just to sum that up, we have established that selling gold against the dollar in the spot FX markets directly requires the NSFR compliant liquidity providers to have physical gold to deliver against these bets. However, it's the directly related but non-compliant unbacked COMEX market that provides these same market-making liquidity providers who have, as we say, have a footprint firmly in both markets, a flywheel to game the difference between the highly leveraged paper versus the unleveraged physical markets. It's that simple. However, the scope of this trade is limited to how much synthetic open interest can be rinsed without impacting the physical markets, which they have to deliver into. Now, these parameters provide us a simple equation. How much of the intraday COMEX-centric trading volumes can be siloed inside the casino versus what escapes through the EFP backdoor, landing in the NSFR-compliant deliverable spot gold markets. Now, keep in mind that by design, this rigged COMEX flywheel has been enabled by deliberately restricting the ability for US citizens to access the trade in the 10 times larger spot markets. However, since the 1st of January, following gold transitioning into a first-tier asset class, the COMEX EFP backdoor is now providing global central banks and sovereigns looking to diversify out of dollars a seamless, low-friction conduit to convert otherwise undeliverable COMEX open interest into physical. Now, given the increasing number of global physical gold and silver exchanges are trading physical gold at a premium to the COMEX diluted gold price, central banks and sovereigns looking to alchemize paper gold into the reopened January 2023 dollar gold exchange window have stepped up capitalizing on this Fed-induced arbitrable disconnect. The resulting erosion of COMEX paper market liquidity that is being converted into physical gold forces a steady unwind of paper market leverage. As this dilutive liquidity flows out of the casino backdoor, it will become too thin to game, ultimately leading into the Fed being forced to revalue gold on their books before more embarrassing failed repatriation requests are made.
Now, Andrew, you had also mentioned, we're talking about tools. I guess this is the episode on tools here, but you had mentioned another tool that this casino employs to rig the tables. Now, it'd be helpful to explain like how they use this monthly tool to counterintuitively create these air pockets that we can maybe capitalize on.
Yeah, and this is about not being shaken out. This is understanding how simple this game actually is. The casino pit managers, whale-sized footprints are actually impossible to hide. Just like they pulled a similar poker chip sweep of speculator chips in April, The House managers were once again seen to be rigging the machines, which they do, 95% losses, 5% wins, of a similar sweep during May, as we saw in April. And this one, I mean, this one is the trade I referred to earlier, the tool I referred to earlier, which is the trade at settlement tool. Don't glaze over, guys. It's important to understand. This particular house game it's a risk-free. It's risk-free because it's price risk hedged. And on the face of it, legitimately capitalizes on time value by simultaneously buying a front month futures contract and then selling short a further out contract. That should be technically balanced. Fine if they're executed simultaneously, but by scheming to disruptively close one side of the hedge while keeping the other leg open, they turn this spread trade into an illegal practice right under the noses of the regulators. And that is right on the front burner at the moment. Now, during May, as in every other month, we've evidenced the House disruptively closing their long paper market legs of the expiring, and we saw it on the June contract, while deliberately holding back on closing the balancing offsetting short leg of this offsetting trade at settlement tool in August. Now, August spread trade positions, again, this is the spread trade position. So basically June and August is the two legs. Again, by design, this balancing act was concluded just in time to square up their rigged paper gold market short bets at a discount right at options expiration, where you mark everything to market. Now, in plain vanilla form, these legitimate contango capturing arbitrage bets are technically neutral. And while this contango can also be arbitraged in the over-the-counter forward market, we see little evidence of this crossover from COMEX to spot due to the fact that the NSFR compliant spot delivery markets must be physically backed, so it's not risked, as liquidity providers could be called on for delivery into a black swan event, such as we evidenced in March 2020 when this cross-trade backfired last time. If you remember, there was almost $100 spreads between as these liquidity providers desperately tried to close their leverage futures bets. So this leaves the only other synthetic game in town that still works. The siloed COMEX futures spread trade, which we just talked about, which is primarily capitalized on by the insiders privileged to operate in the commercial swap dealer category, which are listed on the various reports. But outside the casino, central banks and sovereigns are exercising their right to convert these paper trades into spot deliverable NSFR compliant contracts using the COMEX EFP conduit. And these outflows are consistently narrowing the scope of this COMEX-centric paper trade due to the fact that insiders exposed to the physical delivery obligations in these NSFR compliant spot markets only dare act within the scope of this narrowing paper trade. And it is narrowing. And acting as sanctioned Fed agent market makers enables these banks to also act for their own book, fully insulated from losses while they manage the Fed's book. Now, laughably, while these siloed games get played outside the casino, these COMEX, these competing central banks and sovereigns are stealthily converting the paper gold and silver discounted prices into physical bullion and are removing it from the illusionary world of the casino. And as we previously assessed, due to the convertibility of the resulting paper price into a first-tier asset class by triggering the casino's EFP backdoor, the degree the house can capitalize on this is capped on how much speculator open interest can be offset, so as not to expose the house to real physically delivery obligations they're in no position to fulfill. Furthermore, each time the Fed-driven agent bank selling triggers such a rig price rinse, they drain paper market liquidity, further limiting the future scope of these games, which are reaching an inflection point that cannot be sustained and that is actionable. And over the last 3 weeks of May, these synthetically operated air pockets have once again exceeded CFTC position limits. And that's obviously what is reported to the CFTC, but obviously officially sanctioned, because otherwise nobody would dare do this. With all the regulators now looking over it, you have to have an exemption to actually exceed position limits on the regulated futures exchange. So this month's TAS rinse has once again enabled these market-making agent banks to be able to buy back their August shorts at a massive discounts for themselves and the Fed. So that's what it was. Pull one side, create a massive discount, go and buy all these shorts at a discount. That's what happened. But this is the point we're trying to draw attention to. This central bank size T+2 spot gold demand, meaning that once it gets out of the EFP into the spot market, it's forced to be delivered on within 2 days. This gold demand now far exceeds what was window dressed by the cartel into this siloed PM fixes. When I say siloed fixes, we're talking about just a very few banks limiting the amount that goes on within that fix. Yet it's a globally set price, which is capitalized on elsewhere. So liquidity providers confirm that very, very large central bank buying has been occurring into these synthetic dips. And the reason we're drawing attention to these games is to push back against the Fed-driven psyops action and to point out that the real physical exchanges are forcing 50 years of paper market dominance to fail. We're witnessing it. The only question, guys, is how much physical gold do you own?
And thank you so much, Andrew Maguire, for talking gold. Like we always say, you can't get this information anywhere else. And remember, to our whole Live from the Vault community, buy physical, and make sure it's backed 1-to-1. And understand the difference between what Andy calls, and he affectionately calls, the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. And there you have it. That's all we have for you today on another fascinating episode of Live from the Vault. Please help keep spreading the word about this channel by hitting that like button right there, hitting the share button right beside it, and also hit the subscribe. Now, if you click on that bell right in front of you, you'll be notified in real time as each episode goes live. And with that, we'll see you next time right here on Live from the Vault. See you then.